Welcome to the Wealth Path, the place where we simplify personal finance and make building wealth feel possible, no matter where you're starting. If you've been curious about investing in the stock market but felt overwhelmed, confused, or maybe even intimidated, this video is for you. Today, I'll guide you through 5 clear steps to start investing in 2025, even if you're starting with just a little money and zero experience. Let's be honest, investing can sound complex. But here's the truth. It's one of the most powerful tools to grow your money over time. If you've ever wondered how people build wealth while they sleep, investing is a big part of that picture. And with the right approach, you can start doing the same today. Step 1. Understand why you're investing and set clear goals. Before we talk about apps, stocks, or strategies, you need to understand your why. What are you investing for? Are you planning for retirement? A future home? Building passive income? Your goals will shape every decision you make. Investing isn't gambling. It's a long-term plan to help you reach financial independence, and like any journey, it starts with knowing your destination. Also consider your timeline and risk tolerance. If you're young with decades ahead, you can afford to take more risk. If your goal is 3 to 5 years away, you'll want a safer, more conservative approach. Write down your goals. This clarity will give your investment plan direction and purpose. Step 2. Learn the basics of the stock market. Now let's talk about what you're actually investing in. The stock market is simply a place where people buy and sell ownership in companies. These are called stocks or shares. When you buy a stock, you're buying a small slice of a company. If that company does well, your slice becomes more valuable. If it struggles, the value may go down. But you don't need to pick individual companies to invest in. In fact, most beginners, and even pros, build wealth by using index funds or ETFs, which are collections of companies bundled together. For example, an S&P 500 ETF gives you tiny pieces of 500 of the biggest US companies, all in one investment. This approach gives you instant diversification and lowers your risk. These funds are also super affordable, often charging tiny fees compared to actively managed funds. So, if the idea of picking the next Amazon or Tesla feels stressful, good news, you don't have to. You can invest in the entire market and still build long-term wealth. Step 3. Choose a reliable investing platform. Once you're ready to start, you need to open a brokerage account. This is like your portal to the stock market. In 2025, there are tons of beginner-friendly platforms like Fidelity, Charles Schwab, Robinhood, Sophie, and Public. Look for platforms with zero commission fees, easy-to-use apps, and no account minimums. Many of them also let you invest in fractional shares, meaning you can buy a portion of a stock instead of a whole one. Setting up your account is as easy as signing up for a bank account. Once it's created and linked to your bank, you can deposit funds and start investing right away. Just remember, invest money you can afford to leave invested for the long term. Don't use your emergency savings or rent money for this. Step 4. Build your portfolio with a long-term strategy. Now that you have an account, what do you actually buy? A simple and powerful starting strategy is called the Core and Explore method. Here's how it works. Core, 70 to 90%. This is the foundation of your portfolio. Low-cost, diversified investments like index funds and ETFs. These give you exposure to hundreds of companies and help your money grow steadily over time. Explore, 10 to 30%. This is where you can invest in individual companies you believe in, specific industries you're interested in, or even new technologies. It's a smaller slice of your portfolio and should always be money you're comfortable taking more risk with. And here's the secret sauce. Consistency beats timing. You don't have to wait for a perfect time to invest. Use a strategy called dollar-cost averaging, where you invest a fixed amount on a regular schedule, weekly, bi-weekly, or monthly. This keeps you investing through market ups and downs and helps smooth out your average purchase price over time. Step 5. Avoid mistakes and stick to the plan. The hardest part of investing isn't starting, it's staying consistent. So here are a few beginner mistakes to avoid. Don't try to time the market. No one, not even the pros, can do this perfectly. Don't panic during market dips. The stock market goes up and down. It's normal. Stay calm and stay the course. Don't invest money you'll need in the short term. Keep your emergency fund separate in a high-yield savings account. Don't follow hype blindly. Just because a stock is trending on social media doesn't mean it's a good investment. Always do your research. Instead, stick to your strategy. Reinvest your dividends. Add to your portfolio regularly. And most importantly, be patient. Wealth is built slowly, not overnight. The longer you stay invested, the more likely you are to see your money grow. Thanks for watching The Wealth Path. If you got value from this video, give it a thumbs up, subscribe, and hit the bell icon so you never miss a chance to grow your money smarter. And in the comments, tell us, what's your biggest fear or question about investing?